Hey guys, Ben Nash from Pivot Wealth here, and today I'm pumped to be bringing you number 5 in the Smart Money Challenge, which is all about investing. And look, this is where the rubber hits the road. So, investing is really important to get right if you don't want to work forever, or you want to at least have the ability not to work forever. So, what I'm going to cover today is some of the investing basics, the things that you need to understand in order to make smart investment decisions. We're going to start big picture, and some of this stuff you probably already know, but bear with me while we build on a bit of existing knowledge and work towards actually the sorts of solutions and the key decisions that you need to make when you do invest. I'm going to frame this up again, and I've shared this example in the previous step of the challenge, which is all around the power of time and some of the results that you can expect when you do invest. And I think this is why it's so important to keep front of mind, because I think when we invest or when we think about investing or go to invest, people often underestimate how much they can do over the longer term, but they overestimate or what they should be doing in the shorter term. And that often leads, if you're overestimating how much you can or should be doing in a short amount of time, that's when you can sometimes you get off track because you get frustrated and then you don't follow through, and that means that you miss the opportunity to keep that momentum building. So I've got a couple of different examples here of different saving levels over time. So what I'm talking about is saving money and investing it into the share market average. And we can use the Australian share market average, which is what I've used here, of 8.7%. It's like the 25-year return, although the actual return at the moment is higher because of the COVID disruption. But 8.7% is a really reasonable expectation, in my view, in terms of the long-term returns moving forward. If you were to invest in a more diversified international share portfolio, then I think that number is closer to 8.8%, but both very similar. And in my view, like I say, very reasonably achievable over time. So what I've got is investing. If you save and invest $1,000 every month, so $12,000 over a year, over a 10-year period, you would have invested $120,000. But with the power, like growth on your share investments, as well as some dividends, which we've assumed are reinvested into the portfolio, your portfolio at the end of that 10-year period, based on that long-term 25-year return, would be about $190,000 in total. After 20 years, though, you put in a total now of $240,000, but you start to see the benefits in compounding, that the portfolio value, if you've done this for the last 25 years, based on this long-term return figure, as I mentioned, you would now have $642,000. So you've gone from 190 to $640,000, an increase of like $450 plus thousand in 10 years, more than double. So we see that the amounts are sort of escalating. Years 30 would be $1.72 million. Again, just continuing to build that momentum, investing in the boring old share market overall, and keeping that going for 40 years would be $4.2 million. That's investing $1,000 every single month, which I think that equates to less than 4% of the average disposable income in Australia. So I get that, COVID disruption has thrown a few people out, and there's definitely points throughout people's lives and careers where that's not realistic or achievable. But I think for a lot of people, it should be. Then if you double that and you were to save $2,000 a month, well, the numbers all just double. Basically, the 10-year return is $380,000, 20-year return, $1.28 million, 30-year return, $3.4 million, 40-year return, $8.5 million. So it's a linear thing in that you double the amount you're putting in, you double the results that you can expect. But you can see this, that basically 20 years, you can have $1 million over $1.2 million, in fact, just by investing $2,000 a month. Saving $3,000 a month, you see that the numbers just triple. So this has after 10 years, $570,000. After 20 years, $3 million. After 30 years, $5.16 million. After 40 years, $12.85 million. So the numbers are pretty sort of staggering there when you think about them. And it's the power of time, but it's also the power of putting yourself in a position to actually get started and take action. And so what I'm going to do is I'm going to unpack some of the myths and mistakes that people make that stop them from actually taking that action, because the fear of getting started is a really powerful one. You see that saving $3,000 a month, well, the numbers just all triple essentially. So after 10 years, you'd expect your portfolio to be at about $570,000. After 20 years, $1.928 million. 30 years, $5.16 million, and 40 years, $12.85 million. And now I appreciate that saving $3,000 a month is not a small amount of money. But again, you can see that if you are able to push and save it that much, you can build some really rapid momentum fairly quickly as well. But the thing is that the fear of making a mistake, not knowing, not understanding investments, where the risk is coming from, how to manage that, how to set up a portfolio, is a barrier that stops a lot of people from getting started. And that's exactly what I want to unpack today. So you know the key things to look out for, the questions to ask and answer to give you the confidence to pull the trigger and get started investing. because you can only manage the risk that you understand. It's risk comes with any sorts of investments. Investing in shares is risky. Investing in property is risky. Investing in crypto is risky. Doing nothing has risk attached to it as well. So the key to risk is figuring out what risks you're comfortable with and what ones you're uncomfortable with. And then once you find the risks that you are comfortable with, you want to include as many of those as possible into your strategy, because that's going to allow you to get more results more quickly. And then you want to avoid the risks that you're not comfortable or less comfortable with as much as you can. So we're going to talk about those different risks here. Now, the first thing that you should understand before we get straight into the risks directly is investment mix, and in particular, the risk versus return trade-off that comes with different types of investments. Now, there is a relationship there, obviously. The lower risk investments are, the lower return you can generally expect. And then the higher risk investments, higher expected return. And when you think about the types of investments and investment mix, what we're really talking about is asset classes, but also growth versus defensive investments. So defensive investments are also called income investments. They're investments that are designed to have much lower risk of going backwards. Cash is one of those defensive income investments where you put cash into a bank account. Especially in Australia, cash is guaranteed by the government. And so when you put money into the bank, it's basically not going to go backwards. Now, when you get up into the next category, which is fixed interest or fixed income investments, they call this a whole bunch of different things. But essentially, it's things like term deposits is the simplest analogy for this, where you lock up your money for a period of time, take on a bit of extra risk, but you've also got a little bit more of a return that comes along with it. When you think about investment risk in a diversified portfolio, or like in your superannuation funds in Australia, for example, what you're talking about is really things like corporate and government bonds, where you're lending money to a Woolworths or a government body. And depending on how long you're prepared to lock up your money for and the interest rates at the time and the risk involved with those investments, you get a slightly higher return. But with fixed interest type investments, they're typically backed by investments, backed by security. You think about Woolworths issue corporate bonds, it's backed by the assets that they hold in their supermarkets and inventory and contracts and these sorts of things. So if Woolworths was to go bust tomorrow, even though that's highly unlikely, then the people that have these bonds get paid first in order of how they issue the bonds. And there is a fair bit of complexity there, but essentially the more risk that's involved in a bond, the more return you can expect. Then, so those are the defensive or income type investments. And then when you move over to the growth type investments, what we're talking about here is residential and commercial property, Australian and international shares, investments that are designed to grow. Some of them do produce income. A rental property will produce you income. An Australian share investment will give you dividends. An international share may or may not give you dividends. Typically with the bigger companies, they do. But the main focus for the investment itself is in growth. Now, because the growth is dependent on the company, the business, the economy, then we do see more volatility, more ups and downs in these sorts of investments. Although, and we'll talk about how to choose good ones, but you manage your risk, and over time, these investments over the long term, when you choose good ones, tend to grow more than what you would expect from the income return on a defensive type investment. So your investment risk in financial planner land, this is what we call your risk profile, which is one of the key decisions, the things that you need to get right when you're deciding on the mix of investments that you're going to include in your portfolio. And the more defensive investments you have relative to growth investments, the more conservative we would say that you are. A conservative investor, say if we were working with a conservative investor, they would have about 90% of their portfolio in defensive investments, 10% in growth investments. whereas a balanced investor would be 50% growth, 50% defensive. A high growth investor would be 90% in growth investments and only 10% in defensive investments. So that mix is going to be a key driver of your long-term returns over time. And something to keep in mind when you think about your risk profile or your investment risk, you might have a CommSec or a self-wealth or a raise account that has a certain investment mix or a certain risk profile in it. Then you might have a property investment, you might have a term deposit, you might have a high interest savings account. So there's also a global investment mix or a global risk profile that you have. And there's some strategic considerations that I'll talk through around that as well. But essentially, this is one of the most fundamental decisions that you need to get right. Now, growth investments are generally investments that have a longer expected time frames, and I'll get into investment timelines. And then defensive investments are ones that have shorter investment time frames, i.e. if you know that you're about to go on maternity leave in 3 months' time, you need the $50,000 that you've saved up to cover your living expenses for the next 12 months. Investing that into a share investment or a crypto investment or a property investment carries a bit of risk, because depending on what happens in the market, your investment could go down in value and then your money isn't there at the time that you need to actually call on it. So it is really fundamental to get right. Investment timeline, we know when we think about the market overall, this is the next thing we need to understand, that share market goes up, share market goes down. Over the long term, the time tends to de-risk the majority of risks such that you'd expect it to go up. But at any point in time, the share market, and COVID disruption is a perfect example, very quickly we see 40, 50% wiped off the value of the share market, which means that if you're forced to sell at that time, you can be selling at a significant loss. Now, they say that you should be prepared when you do invest in shares to prepare to leave those investments for 7 to 10 years or more in the event of a serious market downturn and prolonged economic sort of downturn that takes a long time for the economy to recover. The GFC back in 2008, the global financial crisis, was a good example of this, where it did take a number of years for markets to recover to their recession levels. Now, COVID was a bit of a different one because the governments just started handing out money to everyone left, right, and center. So there was a really quick recovery. But that's not really what you should plan for if you're trying to effectively manage risk when it comes to your investing. Another thing that's important to understand is good versus bad risk. And what I really mean is big company versus small company risk. Now, if you think about a company like the Commonwealth Bank, they're the second largest company in the country at the moment behind Commonwealth Serum Laboratories. The share price does go up and it does go down. And in the COVID disruption, we saw a lot of money wiped off the value of the CBA share price. But over the long term, you'd expect it to go up. Now, if you can compare that with a smaller company, and the example that I use when I'm talking to our clients about this is a fictitious diamond exploration company. They own a small plot of land out the back of Western Australia somewhere and are hoping to strike it big with their diamonds. The return profile on that particular investment is going to be very different. You're going to get a lot of periods of flat, and then you see big ups and downs. If they found the diamonds, have they not found the diamonds? And it goes, and that continues over time. And then they generally go gangbusters and go up, or more commonly, as the stats show us, that they go bust and fail or fall into a really prolonged poor performance over time. Now, a lot of people, going back to my investment risk or risk profile element of this conversation, when people think that they go from a conservative investor to a balanced investor to a high growth investor, they often think if you don't have a lot of experience with investing, people fall into the trap of thinking that it means that you're cramming tons of these small companies into your portfolio. So you're going to get lots and lots of volatility and you're massively increasing your risk of your investments going to nil. That's actually not the case. All you're doing is you're getting more and more of these good quality big companies in your portfolio and less of the cash and the defensive type investments. So important to understand. I think both have their place, although my personal view in terms of philosophy around this is that you want to ensure that when you do build the foundations of your portfolio, that we're stocking it full of rock solid blue chip stable big company investments that you can sleep like a baby at night knowing that you're going to get good returns over time. There's not a lot of company specific risk or risk of total investment failure. I'll talk a little bit more about that as well. Another thing to understand is diversification, and diversification is a really key risk management strategy. A lot of people, you've heard this term, no doubt, it's diversifying your risk. And the example that I use here is to say that if you got a share in, if you got $10,000, you invest half of it into CBA and half of it into Woolworths. These are both big, good companies, what you'd consider a blue chip share, but they're different companies. So they're going to have different growth trajectories, although they do broadly follow the same economy. So you'd expect them to be sort of in line, but also sort of different. Now, when you invest in two different companies, the highs of one balance out the lows of the other, and then your return profile is smoother over time. That's with two companies. You invest in 10, 20, 200, 2,000 companies. What you're doing is you're reducing the impact of any one particular investment on the return that you receive overall, and the return is smoother over time. So diversification, we tend to follow a highly diversified approach because ultimately we want to get to that share market risk, that nice boring old 8.7, 8.8% year in and year out return, betting on the fact that capitalism will continue to reign, good companies will make smart money, and like I say, you sleep like a baby knowing that you don't have all of your eggs in one or two baskets. So if we look at the share market overall, and these numbers are actually a little bit out of date, but at the time that I put this graphic together, you can see the composition of the market. Now, if you look at the news at night and see the ASX 200 has gone up by 1% or down by 0.5% or whatever those numbers are, you know what the numbers are, you know what the value of each of these companies are, because it's all publicly available information. So the biggest companies have the biggest allocation. I mentioned CSL is the biggest company in Australia. It accounts for about 8 or 9% of the total share market. Then you got CBA about 8%, the big banks, mining companies, etc. And then the smaller companies, as you go down the list, result in a smaller and smaller proportion of the total composition of the market. We know that the value of the share market overall is like this $1.7 trillion thereabouts over time, that if you wanted to replicate the return on the share market overall, all you'd need to do is get a bunch of money and put it into the exact same allocations and keep them the same over time, and the return on your portfolio would be exactly the same as the return on the share market. And that's exactly what passive or index funds do. Now, and this is what I'm working into, is like one of the other key investment decisions is, do you invest passively into index type funds, or do you invest in a more active way? And I'll explain both types and the advantages and disadvantages of both. When you invest in index funds, like I say, they're just tracking the market. They run essentially by computer algorithms that are really smart, that follow what's going on in the market and ensure that a passive or index fund just replicates the exact allocations of the share market itself. There's a really tiny tracking error because these funds are generally based on information that's publicly available. So there's a tiny little what they call a tracking error, which is a gap, but it's really inconsequential when you think about the returns over time. Also, the share market composition doesn't change a lot in the short term. It's only really there are long-term trends that do have an impact on the market. So these funds are very diversified. They're very low cost because they're very simple, straight up and down. They're just tracking the market, and they're very the proposition that you're getting with this sort of investment is that you're just going to get the market return. They won't outperform or they won't underperform. They're just going to perform basically the same as the market itself. On the other hand, actively managed funds are funds that are trying to perform differently, but most often better than the share market itself. So you might have an investment manager, some guru, a research team, maybe a computer algorithm, or some other proprietary formula or system that's saying, we think that, no, we don't want to put the most amount of money into CSL or CBA. We want to put it into ANZ or Telstra or whatever else they think is going to get the return in line with the investment philosophy of that particular fund. Now, because nobody can see the future, it's very, very difficult for them to consistently perform better than the market. And in fact, the stats show us, and for any people that are interested, or the engineers or detailed focused people out there, check out the SPIVA stats, SPIVA. They do a big comparison on all of the actively managed funds across the globe versus their passive counterparts. And the stats show that I think it's 85 or thereabouts % of funds in some categories more of actively managed funds fail to outperform the passively managed counterparts. And a big part of that is because the fees of actively managed funds are significantly higher than passive funds. Passive funds generally charge less than 0.5%. Actively managed funds, and they are getting a bit cheaper, but they're normally 1 to 4% plus a performance fee on top. And because when you think about all the actively managed funds and all of the passive funds, they do end up being the market, or it's generally a pretty big proportion of the market. And therefore, if you've got the market, there has to be some that are doing better than average and some that are doing worse than average. And if you've got one charging really low fees and one charging really high fees, again, that's where they can it's hard for the active funds to keep up. Now, there are some exceptions to the rule. I think where active funds can work really well is if for people that are getting closer to or in retirement, where it's like a different risk proposition. There are some specific themed funds, which are quite interesting as well, which aren't, again, it's a slightly different proposition, but the stats show us, as I say, on balance, that it's 85+% of these active funds fail to outperform, and they're charging more for the privilege. And the other big thing, and it comes down to your philosophy, but in my view, the other big downside of these active managed funds is because you don't know, how they're going to perform or when they're going to recover or how they're going to recover. It means that you're running the risk of, you have to be stressing about your fund, your portfolio over time, because you don't know whether it's going to recover or when it's going to recover or how it's going to recover. So the key things when you think about investing and how to actually make it happen, the key considerations to ask yourself: understanding growth versus defensive investments and the right mix for you, understand your risks and where they're coming from, clarify your investment timeline, and make sure your investment timeline is consistent with the investments that you've chosen and how they fit together. Understand active versus passive investing and choose the right one for you at the right time as well. Look ahead and then take action. And I'm going to talk about how to wrap this all together into an actual plan and targets in the next session for the Smart Money Challenge. But these are key investment things that you need to understand. Stay tuned for goals and planning coming up to you next. Cheers, guys.